U.S. nat gas futures are facing early pressure this Monday, extending the downward momentum from last week. The diminishing weather-driven demand is fueling bearish sentiment, driving prices lower. The market has begun the week beneath key technical thresholds, and with mounting storage concerns, traders are becoming more doubtful about the chances of a meaningful recovery. A significant driver of last week's bearish trend was the larger than anticipated increase in natural gas storage levels. The Energy Information Administration reported a 35 billion cubic feet injection for the week ending August 16, surpassing predictions and intensifying fears of a supply glut as the shoulder season nears. Even with production cutbacks from major producers like EQT and Coterra Energy, worries about oversupply linger, particularly with production in the lower 48 states remaining close to 101 billion cubic feet per day. The rebound in LNG exports following disruptions caused by Hurricane Beryl adds another layer of complexity to the supply-demand equation. In the coming week, national demand is projected to stay high to very high, but it is expected to ease to moderate high during the 8 to 15-day period, as cooler temperatures in the northern U.S. bring comfortable ranges from the upper 60s to 80s. However, the expiration of September 2024 contracts and whether U.S. production reports come in above or below 100 billion cubic feet per day could have an even more significant impact on market dynamics this week. U.S. nat gas futures are currently trading decisively below the $2.10 mark, providing a favorable environment for short sellers. This situation is particularly challenging for those holding long positions, as bears are now setting their sights on the recent low of $1.90, with the potential to push prices even lower if selling pressure continues. Some traders are even eyeing targets as low as $1.60 under the present conditions. Despite the prevailing bearish sentiment, producers may soon contemplate production cuts to rebalance the market, similar to earlier this year, especially if prices keep falling. In the short term, as summer demand decreases and storage levels remain elevated, prices are expected to continue experiencing downward pressure. While late summer heatwaves might provide temporary relief, a substantial price recovery is unlikely until the winter heating season begins. Currently, the market is susceptible to further declines, with the $1.90 level acting as a critical support. If this threshold is broken, it could lead to additional selling pressure. Traders should pay close attention to upcoming EIA storage reports, weather forecasts, and global demand trends for any indications of changing market dynamics. Throughout the week, nat gas prices struggled to breach key resistance at the $2.30 mark. The market retested the crucial support at $2.10 several times, fueling concerns about the possibility of further declines. If nat gas closes below the $2 support level, it will likely move towards the primary support at $1.90. Traders should prepare for a market that could become increasingly bearish in the near term. However, I believe we are in a phase where the market is attempting to form a bottom. Any short-term dips below the $2 support are likely to create buying opportunities for value-oriented traders. Looking ahead, a price increase above the $2.10 level is expected within the next 1 or 2 weeks. Please like, subscribe, and comment to support the channel. See you in the next one.